Hi and welcome to this video. My name is Louis from The Fun Accountant. In this video we are going to look at the most important aspects that influence estate agents' tax affairs. I'm going to present basic tax considerations. This video is merely for informative purposes only and does not constitute tax advice. For tax advice applicable to your needs, please contact your own registered tax practitioner. The video consists of 6 chapters. In the first chapter, we're going to look at the independent estate agent versus an employee estate agent. Both are taxed differently. The second chapter, we're going to look at independent contractors' taxes test. Thirdly, we're going to look at typical clauses in contracts, reinforcing the estate agent's independence. In the fourth chapter, taxation arrangements of an independent estate agent. Fifthly, we're going to look at the tax responsibilities of an independent estate agent. In the sixth and last chapter, we're going to look at the course of action for an independent estate agent. Estate agents considering their tax options have to draw a clear distinction between an independent estate agent versus an employee estate agent. The reason for that is because the income of these two types of working arrangements are taxed differently. An independent estate agent, in essence, operates as a standalone independent business. On the other hand, an employee agent works for commission in an employment relationship with a company. In the real estate industry, the relationship between the individual estate agent and the real estate company or broker can be vague, and it is not that simple to pin it down. The safest route to take is to be guided by the Revenue Services guidelines, because they are the guys pivotal in determining the responsibility of an estate agent as to how to account for money received, expenses incurred, tax liability, and the manner of tax payments. What now follows are extracts from and definitions laid down in Interpretation Note 17 from the South African Revenue Services, dated 5 March 2019. In order to establish an independent working arrangement or agreement, as opposed to an employer-employee relationship for tax purposes, the person's independence is determined by the exclusionary subparagraph of the definition of the term remuneration. This means that if your earnings are defined as remuneration, you are not, I repeat, not regarded as an independent contractor of the company paying you. Then you are classified as being in an employment relationship with the employer, having the responsibility to deduct pay as you earn from your earnings and pay it over to the Revenue Service. We are now in chapter 2 of the video that covers independent contractors' taxes test. Now, what on earth is that? Well, that's basically a rule written down in law by the Revenue Services to provide clear guidelines as to when they, and that is the Revenue Services, deem a person to be an independent contractor or an employee for tax purposes. As this distinction has a crucial effect on the outcome of a person's tax computation and tax payments. So how does this test work? To conclusively deem a person not to be an independent contractor for employees' tax purposes, 2 tests have to be passed. A person shall not be deemed to carry on a trade independently if and when the services or duties are, the terms for test 1, required to be performed mainly at the premises of the client, and the worker is subject to the control of any other person as to the manner in which the worker's duties are or will be performed, or as to the hours of work. And now for test 2, a person shall not be deemed to carry on a trade independently if the worker is subject to the supervision of any other person as to the manner in which the worker's duties are or will be performed, or as to the hours of work. In Test 2, there is no reference made to the premises. So irrespective of where the worker is working, if that worker is subject to the supervision of any other person, in terms of duties and hours work, that worker is deemed to be an employee. Where either Test 1 or Test 2 apply positively, the worker is deemed not to be an independent estate agent. The result of that is that the amount received by the estate agent is therefore not excluded from remuneration, and tax must be deducted accordingly as employees' tax, also known as pay-as-you-earn, from the income received by the estate agent. In contrast, no tax will be withheld by the company from the earnings of an independent estate agent. In short, an estate agent's independence is determined by where duties are performed and or control exercised over the agent in terms of how duties are performed and or control over when duties are performed. The three things to consider is the where, the how, and the when. The real determining factor of an agent's independence is the contract between the two parties. We are now going to look at the terms of a typical agreement that clearly establish an independent relationship and not an employment contract. These terms written into the contract between the agent and the principal attempts to address the SARS rules of supervision over the time and the manner of how duties are performed. The estate agent shall be free to develop his or her real estate service business, such portion of his or her time, energy, effort, and skill as the estate agent sees fit, and to establish his or her own endeavours. The estate agent shall not be required to keep definite office hours, attend sales meetings, or adhere to sales quotas. The estate agent shall not have mandatory duties except those specifically set out in this agreement. Nothing contained in this agreement shall be regarded as creating any relationship, such as employer-employee, joint venture, partnership, or shareholder between the parties, other than the independent contractor relationship. Another clause that may point to the fact that there is not an employee-employer relationship is that the estate agent may be a natural person, a company, or a closed corporation. Each of these entities are taxed differently. A contract can also go as far as to include certain taxation agreements to remove any doubt about the agent's independence. Typically, an employee incurs no business expenses and is reimbursed or granted allowances for expenses on behalf of the employer, while an independent contractor incurs business expenses such as advertising, entertainment, bookkeeping, wages, travel, etc. Similarly, an employee might not have to register with the Department of Labour as a labour broker or employer, or with SARS for value-added tax as an enterprise, or for pay-as-you-earn as an employer, where an independent estate agent may have to, depending on their circumstances. The independent estate agent's clause on tax responsibility reads: the estate agent understands that he/she is entering into this agreement as an independent contracting estate agent and not as an employee. The estate agent understands that it is the estate agent's sole responsibility for paying all income taxes, withholding taxes, and other taxes and amounts required by law for the estate agent's compensation and all other payments to the estate agent, if any. Neither the estate agent nor any of his, her, or its staff is an employee or agent of the company for any purposes whatsoever. The company will not withhold and pay any income or other taxes on the estate agent's compensation. The company will have no responsibility to provide any insurance, retirement or other employee benefits to the estate agent. The estate agent will not be treated as an employee with respect to services rendered by the estate agent pursuant to this agreement for tax purposes. In practice, this means that no taxes will be withheld from the estate agent. It also places a responsibility on the estate agent to provide for his or her own taxes as a business and to provide or make provision for a tax bill as a provisional taxpayer, normally 3 times during a tax year. Further clauses in the independent estate agent's agreement with the company deals with the estate agent's responsibility for all the expenses related to running an independent business. The estate agent shall be responsible for the following expenses: fees due to the Estate Agency Affairs Board, legal practice counsel, cell phone expenses, business cards, signs, signposts, advertising, personal branding, continuing education, licensing, printing, copying, and so forth. The tax responsibilities of an independent estate agent. So you are now classified as an independent estate agent for tax purposes. How do you manage your taxes now? Start to understand that you are a provisional taxpayer. A provisional taxpayer is defined by Revenue Services as any person who receives income or to whom income accrues other than remuneration. Most salary earners are therefore not provisional taxpayers if they have no other sources of income. To quote the Act, a provisional taxpayer is defined as any natural person who derives income other than remuneration, a company, or a person who is told by Revenue Services that he or she is a provisional taxpayer. There are instances where a person can receive income other than remuneration, like a state agent's commission, and be excluded from being a provisional taxpayer. Provisional tax exclusion test 1 of 2 is any natural person who does not earn any income from carrying on any business, provided that person's taxable income will not be more than the tax threshold. Or provisional tax exclusion test 2, the taxable income of that person earned from interest, foreign dividends, rental from the letting of fixed property, and remuneration from unregistered employers will not be more than 30,000 Rand per annum. The practical implication of being a provisional taxpayer is that the buck stops with you. You will have to enforce self-discipline to put money away to provide for the glooming tax guillotine above your head. Nobody is going to deduct tax from your income, and no one is going to create a tax certificate for you. You need to create an income statement as laid out in the example to follow, and you will probably need a professional accountant to assist you with your tax return. But most important of all, if you do not keep proper records of your expenses with the necessary knowledge of what is deductible from your income to derive at the net profit, which is one of the markers needed in your tax computation, you will lose out and pay more tax than is lawfully required. The final tax amount due by you is determined with real figures, unlike provisional taxes, which is based on an estimate. It will be helpful to think of your provisional tax payments as credits, which will be deducted from your final tax amount to arrive at a tax liability or refund. Let's look at how to calculate the income tax on an estate agency business in general. We always start with the commission income at the top, less allowable tax deductions, which is expenses related to the estate agent's business, and that equals your business profit. Add other taxable income, less exemptions like interest exemptions, less special deductions like donations to public benefit organizations or retirement annuity fund contributions. That equals the taxable income, from where we will calculate the income tax according to the tax tables as an individual or the tax rate as company tax. Less Section 6H rebates, less Section 6A medical tax credits for medical aid contributions, less Section 6B additional medical tax credits for additional medical expenses, and that equals the tax amount payable. Now we are going to do a practical example of an estate agent's tax calculation using 2 possible scenarios. In the 2 scenarios, both entities have exactly the same income and expenditure. In the first scenario, the estate agent trades as a sole proprietor or individual. In the second scenario, the estate agent trades as a company. In the company, the agent gets a salary of 226,000 Rand, and the company also has to deal with dividend tax, which is not required for a sole proprietorship. We need to account for a salary and dividends in a company in order to get both scenarios on the same playing field so that we can compare the tax amounts payable on the same set of figures. What you see now is a complete tax calculation for an estate agency business. We start with page 1 on the left side of the screen, ending with the net profit from the business as the last line, followed by page 2 on the right hand side of the screen. These figures looks a bit daunting, but when you look at it line by line, you will find that it is fairly simple. We are also comparing the tax payable if an estate agent trades as a sole proprietor versus a company, assuming that only the estate agent is employed in the company. Both entities have exactly the same income and expenditure, except for the salary provided for to the estate agent in the company, on which the agent will pay 18% tax. At page 1, which is basically the income statement of the business, we start with the commission income line of 500,000. We then have the typical expenses of a real estate business. I am not going through each line in detail. You can find and download this presentation on our website, where you can go through the detail at your own time. The total expense amounts to 89,000 and 315,000, leaving a net profit from the business of 411,000 in a sole prop and 185,000 in the company. We carry the net profit from the business over to the tax computation section on page 2. Firstly, the company tax is calculated at 28%, resulting in 51,800. Then dividend tax has to be calculated on the remaining profit distribution to the estate agent, resulting in 47,360 dividend tax. We are now in the individuals tax section of the calculation, where we just put the salary amount down in the right column of the company in order to calculate the individual's tax amount. We add other income like interest received and deduct from that the exemptions that may apply, like the annual interest exemption of 23,800 Rand. We then deduct other special allowance and deductions provided by the Tax Act, like pension fund contributions. The result is the taxable income on which tax is calculated according to the tax tables of 2023. These tax tables changes every year as announced by the government, normally in February of each year. You can see the sole props tax amounts to 95,540, while the tax on the salary portion of the profit in the company is 42,860. But we still need to add to that the company's tax, as well as the dividend tax. After deducting the age and medical rebates, we arrive at the total tax liability. In the sole prop, it equals to 71,838. And the total tax for the company and its owner amounts to 118,318. From the tax liability, we deduct employees and other taxes withheld as per the RP5 certificate, and the first and second provisional taxes paid during the year, leaving the final tax amount due. It is clear that trading as a company will not always ensure the lowest tax liability. Comprehensive planning is required with a company, coupled with keeping company records and other obligations, which will result in an escalation of costs. The company's tax can be minimized when it is classified as a small business corporation, as defined by the Tax Act. Only a limited number of companies qualifies as a small business corporation due to all the conditions that must be complied with. Delving any deeper into this subject is beyond the scope of this presentation, and I would advise you to seek professional tax advice if you consider trading as a company. We are now going to look at general guidance and a few points that may assist you as to when to consider trading as a company instead of as a sole proprietor, because there are instances when it is beneficial to do business as a company. You become an employer and you have employees and therefore have to register your business as an employer at the Department of Labour, SARS, and Unemployment Insurance Fund. Your turnover is in excess of R1 million and you have to register for that. Partners are joining you in the business, and for continuity benefits, issuing shares may be better than partnership agreements. You have 3 or more unrelated people full-time employed within the business, which will ensure that you meet the requirements as a small business corporation, and as a result receive the benefits of a small business corporation being taxed at lower rates than a normal company. Let's say that you are an independent estate agent as defined and discussed earlier. What now? What should you do or not do? Start by knowing your status. Are you an employee or independent contractor as defined by Revenue Services? Save money for tax. Put 25% of your gross income away for taxes so that you don't get any nasty surprises later on. Submit provisional tax returns, thereby avoiding penalties and interest. Keep accurate records of all expenses. Taxpayers lose millions of rands in excessive taxes by not keeping records of all their expenses. There are technology products available, like Text, that simplify the keeping of records and storing it to prove the claim later as an expense. Remember the basic rule: expenses incurred in the production of income are deductible from income for tax purposes. Stay up to date with your accounting records using an online accounting system that is kept up to date so that you have minimum admin work and that can be accessed from anywhere will be a great asset in your business. Know your financial position at all times. Claim your workspace as a deduction from your income and keep a logbook of your travel kilometers. Get professional help early before it is too late. In the long run, having to deal with old records and tight deadlines instituted by SARS cost more than being up to date with your books and tax submissions. Presented on this slide are the tools that many of my estate agent clients use. The DEX product is brilliant for capturing slips and vouchers, storing them and extract them, and is perfect on its own for those agents that are working in an employment arena for commission and who is allowed to deduct expenditure relating to generating their commission income. For the independent estate agent who needs a cloud accounting system, as they would have to generate regular profit and loss reports for tax and other purposes, my preferred product is Sage Cloud Accounting combined with Text. And those who have employees, I recommend Sage Cloud Payroll. For the estate agent to manage properties in addition to their selling efforts, I would recommend adding Netcash to your arsenal of tools. All of these products will help you to do business easy, quick, and precise. Well, this is it. Thank you for joining me on this information session about the basic tax considerations for estate agents. If you are an estate agent and need more help, you are welcome to contact me, where I can put you in contact with the right tax professionals to assist you. Or if you are interested in any of our preferred products and need more information, please click on the links below the video. If you liked the video, please follow the Fun Accountants YouTube channel for more videos where we aim to make business tasks easy, quick and precise.